Hey, welcome to Financial Revelations. I am David Safransky, your host, as I am every week. I wanted to give a big farewell to Janelle from WCRF. We spent our last Thursday morning together. She's going back to being a stay-at-home mom and raising her 6 kids, and I'm excited for her, and it's going to be great for them, and it's really what she and her husband want to do. So I love that they can do that. But I am on WCRF 103.3 every Thursday morning from 8 a.m. to 9 a.m. And you can get the app. That's how a lot of people listen. You can get the app and listen. Or you could, if you're in Cleveland, tune in to 103.3 FM. And if you wanted to get in touch with us, if you have a question, we're going to talk about a question today that we got because it's something that I want to talk about. You could call here. Just pick up the phone and call. It's crazy. 1-800-344-2534. Or you could email Corey@epsf.com. All that contact stuff will be up here. And I'm on Twitter at SkiBucks1. And I love Twitter now because Elon Musk took it over. And to the best of my knowledge, they're not banning people or shadow banning people or if you say something that's against the public narrative or the government story, they're not shutting you down anymore. So it's a really nice place to get news and kind of like raw feed, and I like that. So SkiBucks1 on Twitter. And we get a little political there too, and we talk about things that are important to us. So if you wanted to do an exchange there, ask a question, be more than happy to talk to you about that. And today we're going to talk about probably the hottest topic in the market is not stocks. It's not ETFs in a way. It's not private equity. It's not even private jets, although there are a lot of private jets. You can't make this stuff up. So in Davos, Switzerland, all the richest people, government leaders, billionaires are there talking about climate change. And how did they get there? On their private jets that spew tons of supposedly climate deteriorating chemicals instead of just flying commercial. They can't do that. So they go to Switzerland on private jets to talk about how bad climate change is. So remember, they're not going to enact climate change regulations on them. It's on you and me. They don't want you to fly, but they're going to fly all they want. So the hypocrisy is rich today in Davos, Switzerland. But I'm going to talk about bonds, and bonds are really back in fashion. It kind of reminds me of my wardrobe. If you wait long enough, everything will be back in fashion. So don't throw that slanted striped shirt away. It's going to be back in fashion probably in 20 years. So now, of course, this jacket, I have a tailor that comes to the office. If you want the name of my tailor, I'm not going to give it to you because I don't want you to be wearing this jacket also. So don't even ask me. But bonds are back in fashion, and the reason is the Federal Reserve is just in the market. They are raising rates. In fact, a Fed governor came out this morning after the wage numbers came in, and wages grew at 4 to 5%. That's unacceptable. When they're trying to get inflation to 2%, 5% wage growth, it's not going to cut it. So the Fed governor said, hey, by the way, we might go to 6%. And one of the things that I like that the Fed is doing right now, because it's creating no confusion, they're all on the same page. Now, after today, there's a blackout period where no Fed governor will talk before the Fed meeting, January 31st, February 1st, and they're going to raise rates February 1st. I believe it's going to be 0.5 point. I don't have any foreknowledge on that, but I just think that's the way it's going to be. But all the Fed governors are speaking from the same talking points. And I like that because it's throwing cold water on the notion that the Fed is going to pivot and not raise rates. Now, one thing she did say today is, well, we might slow down the pace of rate hikes. I think that they're going to their reset rate of 5 to 5.25. That's a full percentage point or 1.25% higher than where we are right now. And that is definitely going to dampen the housing market because the cost of money is going up. And if you take a 30-year loan and the Fed funds rate's at 5.25, your loan's going to be at 7. Well, I'm old enough to remember when rates were at 2.5. That was 1 year ago from today. That's how fast this has happened, historically fast for the Feds. But what it has done, with the Fed raising rates like they are, it has brought bonds back into vogue, and we're seriously looking at a lot of different bond holdings right now. And I'm going to go over some of those today, and how to buy a bond if it's in your best interest. Now, as always, your individual situation is going to be different than everybody else's. You're unlike everybody else. So the things that you want, need, and desire are not going to be exactly the same as mine. Your time frames are different. So before you go out and buy a bond or a bond fund, if you've never done it before or you haven't managed your own money, it'd be a good idea to talk to a financial advisor. It'd be a great idea to talk to a financial advisor. So I want you to consider those things before you go out and buy a bond or anything like this. Before you do any investment that we talk about, find out what's in your best interest, your very best interest. What is going to help you achieve those long-term goals and short-term goals that you want? One of the questions that I get a lot from the podcast, from the radio, people will call up and say, hey, I'm going to buy a house, but I don't want to put money in savings. What's something I could get like 8% on for the next year? I said, nothing. You shouldn't take risk with that money. So there's time frames here that are important to pay attention to. And if your time frames are short, we have to really limit the amount of risk that we take. So have that in mind before you act on any advice or anything that you hear here. And the things that I'm talking about should not be construed as individual investment advice for you, because I don't know your situation. Right before I walked in here, somebody called and they want to meet with us, and we're going to meet with them. Well, before I meet with them, they fill out a fact finder. I want to know all about their finances. I want to know how much they make, how much they owe, who they owe it to, how much credit card debt do they have. These are things that are important before you make a big financial decision. We need to know that. And because I don't know that about you, got to be really careful about what you do from the things that you hear here. So why do I want to buy a bond right now? Well, for one, in a 1-year government bond, I could make, as of today, around 4.5%, and that's going to go up at the end of the month. Well, that's pretty good for 1 year. The thing is that if you go longer in government bonds, the rates actually come down, because that's a kind of a recessionary tell when the yield curve is inverted. So typically, you would get more interest to put your money at risk for a longer period of time. But right now, government bonds, that's not happening. And so I don't really want to buy a 10-year government bond right now. It's only paying me 3 and change. I'll buy a 1 year or something like that and get 4.5. Eventually, that yield curve is going to switch back around, and that's considered a healthy yield curve, a normal yield curve. That's what we want, but we don't have that right now. So bonds allow me to go in and de-risk a portfolio. So stocks are risky. You can, in any one short period of time, you could lose a lot of money in stocks, as we found out in 2022. So if I could get guarantees at a good rate, that's what I would like to have, some of that, just to take a little risk out of some portfolios. And government bonds, or bonds in general, allow me to do that. So there's a bunch of different kinds of bonds: government bonds, municipal bonds, which are state and local government bonds, and they could even be tax-free. So for instance, in Cleveland, the city of Cleveland issues a bond. So it's in the state that you live in. It's in the county that you live in, if you live in Cuyahoga County, and the city that you live in. It could be triple tax-free to own that bond. Now, it doesn't mean that you want to own it, because it could be for a project that you're not interested in or you don't think is going to be successful, but municipal bonds could be triple tax-free, because they're also federal tax-free. There's corporate bonds. So corporations like Apple, Microsoft, Ford, GM, they issue bonds when they don't want to issue stocks. If maybe they want to improve their financial position short term and they need cash to do that, they'll issue a bond. If they want to finance a project, they might issue a bond to do that. And that project might have a 10-year time frame. Most corporate bonds, new issue, are for 10 years. And then there's foreign government bonds. There's more risk in that because, one, there's a currency. You could buy them dollar denominated mostly. But if not, there's a currency risk there where when you sell that bond and bring it back to the dollar, you could lose more you could lose money on the currency transaction. So their currency might be worth less at the time the bonds come due, might be worth more, might work in your favor. So there's risk there. So even if risk works out in your favor, it's still risk, and we have to quantify it. So because if it can work out in your favor, it could also work out of your favor. So we need to just know those risks and accept those risks. And the reason why bonds are so compelling right now is because think of a teeter-totter or a seesaw, and on one side you have interest rates, and on the other side you have bond values. Well, interest rates are getting higher, so bond values are coming down. And conversely, if interest rates go down, bond values come up. And what I think the Fed is going to do is they're going to raise rates to this reset rate where they're going to reset the housing market. They've already kind of reset the stock market, but there could be more of that. They're going to reset the car market. They're going to reset anything that has an interest rate attached to it because interest rates are going up. So bond values are kind of coming down, and we want to buy bonds if we can at the top of the interest rate cycle. So even right now, a bond mutual fund isn't the worst idea, especially after the next couple of rate hikes, because I think we are getting pretty close to the top of the interest rate cycle, even though the Fed is talking tough. And they're talking tough, in my opinion, because they don't want the stock market to get ahead of them. And so they're keeping the stock market in check with their verbiage, and they're going to keep the real estate market in check with their interest rates. And I think they're going to 5.25 or thereabouts, maybe a little higher, maybe 5, depending on the data. And then they're going to stop. And then they're going to come back to us in 2024 and say, hey, by the way, we're in a recession, so we're going to bring rates down. And the rate that the Federal Reserve wants rates to stay at would be called their terminal rate. And I think their terminal rate is somewhere between 4 and 4.5%. That would put mortgage rates in the 5s, maybe the early 6s, but most likely the 5s. And that's where they want rates to be. That makes buying a house a little less expensive, but it's not free money. And when the Fed has kept interest rates low for so long, basically at zero, you get things like cryptocurrencies and NFTs. And I did have a lot of people asking me about NFTs, quite possibly the worst idea ever, just after cryptocurrencies. And people were selling NFTs for millions of dollars, and today they can't get $200 for them. So that's what happens when you have free money for way too long. So they're going to assign a cost to buying a house. They're going to assign a cost to borrowing money. And I think it's going to be somewhere around 4.5% on the Fed funds rate. So, and all rates are really based off of that. So if you were to go buy a bond, and the question that we got today from Robert, thanks Robert for the question, is how do you buy a bond? Do you need a guy like me to buy a bond? Do you have to pay somebody to buy your bond? And the answer is no. You don't need me, and you don't have to pay a lot of money to buy a bond. You could open up a brokerage account at a discount broker, and there's a lot of them, and some of them are really good, by the way. So if you open up an account, and I'll just name, I don't mind because they're not really competition to me or anything like that, and they don't bother me. I want to give people the information. If you went to a TD Ameritrade or a Fidelity or a Vanguard, open up a brokerage account, or even at your bank, you can buy bonds there. You can buy stocks. Now, the reason why most people don't know how to do this is because, in general, individuals don't buy individual bonds. They buy bond mutual funds or ETFs. So we buy bonds all the time. I have avoided bond mutual funds in the past because interest rates were so low. But when you're at the top of the interest rate cycle, and what I mean by that is if you think the Fed is not raising rates that much more, or maybe they've stopped raising rates, which will be sometime this year, a bond mutual fund isn't the worst idea because as those rates come down, bond values come back up. That's where you make money. So you want to buy bonds at the top of the interest rate cycle, but there is a little nuance to buying bonds. For instance, I'm going to have Corey throw up a credit rating chart. I keep one of these charts next to my desk because there's 3 rating agencies. There's Moody's, S&P, and Fitch. Those are the big 3. And they all rate bonds differently. So they have different letters. I mean, they're all So, for instance, Moody's is a big A and then two small A's for a triple A. S&P is three capital A's, and so is Fitch. So I just like to remind myself the only triple A rated debt right now is U.S. government debt, backed by the full faith and credit of the federal government. We've never failed to pay our debts, and we're not going to now, so I'm not really worried about that. But as you get lower in that credit scale, whether it be a muni or a corporate bond, you should be getting more interest because you're taking more risk. And then there's this classification of bonds below a certain bond rating called junk, and it's a bad name because they're not all bad, but the lower you go on the credit rating, the less likely you are to be able to pay that company to be able to pay their bills. And so you do have to pay attention to these things. For instance, if I go into my bond buying screen right now, I could get a bond of a local company around Ohio that will pay you 32%, a 32% interest rate. Well, there's a reason they have to pay you 32% because there's a chance that they may go out of business or not be able to pay that rate. You might not want that bond. So the other nuance is duration. When does the bond come due? The longer the bond is out there, so if the bond comes due in 10 years versus 1 year, you should get more interest. Also, what market is it in? Is the corporate bond that you're buying, is that going to be in the real estate market? Because you might want to avoid real estate right now because the Fed is in the market. And then in municipals, is it a general obligation bond versus a revenue bond? So a revenue bond is for a specific project like an ice rink or something that the municipality thinks they're going to make money off of. What if that project doesn't work out? So I happen to like what we call GO bonds, general obligation, because those are backed by the full credit and taxation power of that municipality, whether it be a state, local government, or a county. And if things aren't working out, they just raise taxes. So I kind of like the security of a general obligation bond. And then I always have this discussion with people, individual bonds versus mutual funds or ETFs. Well, when interest rates were really low, I wanted to buy individual bonds because they're guaranteed. And I own the bond. And if you own a bond mutual fund or an ETF, in a low interest rate environment, the odds of rates coming up like they are right now and you losing money are pretty good. So I had avoided bond mutual funds in the past. We haven't really bought this many bonds since 2006. That was the last 2006, 2007 timeframe. That was the last time that bonds were really this good in the market and could make sense for a portfolio. So bonds are back. They're back in style. If you have questions, don't hesitate to contact us. We want to talk to you. We got this great new green screen behind us. We're hoping that it works out. We're experimenting with this. Be patient. If we totally mess it up, the information you're getting is still good. Don't worry about the things that we mess up because the information is good. And as always, seek advice. Figure out what's in your very best interest. And more risk isn't always better. And this is one of the things with individual investors that I kind of help them struggle through. They're like, well, I want to earn 40%. Well, that's really hard to do. It's really hard to beat the S&P 500. So more risk isn't always better. An appropriate amount of risk for you is the best thing. So it doesn't matter what your neighbor's doing. They're probably lying about their portfolio anyway, just like they lie about the fish they catch. Portfolios are no different. So do what's in your best interest. Find advice that's in your best interest if you've never done this before. It may be individual bonds. It may be mutual funds. And as always, you can reach out to us. I am David Safransky. This is Financial Revelations. I am a real American and the voice you can trust.